That we have broadcast for the participant. Now we are live now.
Bismillahir-Rahmanir-Rahim. Rabbi zidni ilma. My Lord, increase me in my knowledge. The most competent gift of God is a life based on knowledge. The saying of Hazrat Imam Ali, Karamallah wajhu. Good afternoon, good evening, and good morning to all participants of this webinar. It's an honor to moderate this very important session of ICAP, and I am thankful to the ICAP Council member as well as Overseas Committee for providing me this opportunity. In this seminar, we have a privilege to welcome Riaz Rahman Saab, past President Council member, our speaker Hamid Hamirani, who is well known to the local community, government official, as well as connected with local global decision makers. I know him for the last 12 years, and he has a strong command on the topic that we are going to discuss. Hamid is an advisor to the minister responsible for financial affairs of Oman. He specializes on soil welfare. He is a board member of Musaddam Power Company, an IPP listed on Muscat Securities Market. And Hamid is also chairman of the Baraka Seawater Company, which is jointly owned by two largest IPP in Oman. He is also board finance committee on the PDO. Now I think I'll move on to I'll give the mic to the Mr. Ashfaq Tola, who is the chairman of the Overseas Committee, chairman of Economic Advisory and Government Relationship Committee, and who has supported and encouraged us to organize this event. Thank you, sir. And Ashfaq Saab, over to you.
Your mic.
Thank you, Adnan. And let's begin the topic. I welcome Riaz Rahman Saab, our former president and current council member. And actually, he is the guest of honor, and he'll be offering the vote of welcome address. I'm extremely grateful to Oman Coordination Committee, which is recently formed by ICAP. And this is again a history that we are doing first webinar from OCC's platform. I am extremely grateful to Dr. Hamid Hamirani, a senior economist, for his capabilities, and I have known quite a few his chums, and they have said he's a very talented guy. And I know from his presentation, which I've seen, I think he's one of the most respectable and most knowledgeable person I've ever seen, which I can guess from his presentation. I think Dr. Hamid Hamirani is a renowned speaker, and he will give us insight on the oil trading and the future scenario of oil, which is right now very vulnerable. We have seen such low ebbs in the oil market. We have seen bumpy rides. We have seen $120 and we have seen $20. We have seen negatives, we have seen positives. So it all depends upon how you strategize it. And we have got an expert today. I know Dr. Hamid is one of the key players in the oil advisory side of Oman. And I know with his knowledge and command, we will get much insight, and ICAP and members of ICAP and community at large, especially our international diaspora of members in the entire world, will be benefited, especially in the Middle East region. So with these words, I will not be in between you and Dr. Hamid. Let me just give this mic to our Honorable Past President, Mr. Riaz Rahman, to offer welcome address. And in the end, our council member, Khalid Rahman Saab, will be offering the vote of thanks. Thank you very much. I am on my way. I might get some disturbed signal and I might get off. So thank you from my side. Thank you. Riaz Bhai, please, for your welcome address. Riaz Bhai?
My mic, okay. Assalamu alaikum, dear fellow members. It's been a while I talked to you. I was regularly speaking to our members, whether local or abroad, during my tenure as a president of ICAP. And I really thankful to Mr. Ashfaq Tola, Chairman Overseas Committee, who's given me once again a privilege to talk to you and being part of this seminar. So officially, Assalamu alaikum and good evening to all of you. Thank you very much. These are very interesting webinar series being introduced by the Institute during the this pandemic situation. and we see the benefit of the technology. We are making most of it, and I would like to congratulate our council member and chairman Ashfaq Bhai for taking the lead, and Khalid Rahman Saab for actively engaging all the chapters of the institute members and the supporting ICAP members to be part of the activities of the institute through various projects. Just to name a few, the OCC recently facilitated signing of an MAU between SOCPA and ICAP, formed by the Coordination Committee of ICAP members in Oman, and the Southeast Asia recently is also working on many more assignments. Well, this is indeed an historic moment for the OCC to organize its inaugural webinar for its member, for which it deserves appreciation. Taking this opportunity, I would like to congratulate our members who have recently been elected to the Coordination Committee of Oman and Southeast Asia and Coordination Committees of ICAP members. So I'm delighted to see the zeal and enthusiasm of our members overseas, especially in Oman, who have supported the Institute in organizing this webinar on future of oil prices, very, very pertinent and important subject. And today's webinar is on a topic that is of interest and affects masses at large, including various oil marketing and importing companies operating in Pakistan as well. So we are glad to have Mr. Hamid Hamirani, who is advisor to the minister responsible for financial affairs in Oman, and he will share his rich experience in this field. So thank you very much, Mr. Hamid Hamirani, for your time and for sharing your knowledge and the subject with us. And I would also like to thank Mr. Adnan Haroon, who will be moderating our today's session. Adnan is a fellow member of the Institute, as Ashfaq Bhai said, and a seasoned banker with 24 years of experience in various multinational banks. He also has experience of working in various countries in his various capacity, and now recently elected as a member of the Coordination Committee in Oman. We have a lot of hopes from him to carry all the members of the Overseas Coordination Committee of Oman to bring him along and participate in future programs of the Institute. So without taking further more time, I would like to hand over the mic to Mr. Dan Harun and Mr. Hamid Hamirani to take us through this very informative and interesting webinar. So thank you very much. I hand over to Mr. Dan Harun.
Thank you very much, Mr. Riazur Rahman Jamria Saab, for your kind word. Definitely, we'll try our best that it's just an initiation and the first step towards the Oman ICAP committee, and inshallah we'll do the more. And before we move on to the speaker, I would like to highlight that Hamid's presentation is based on his recently published article by institutional investors, the part of Euromoney, with readership of around 4,500 institutional investors. So I would like to congratulate Hamid on his global recognition as well. We'll shortly hear from him on the topic. We expect presentation will run over 30 to 35 minutes, and then we'll have a question answer session for whatever the time we left over. We have a limited time frame, so unfortunately we will not be able to take all the questions, but I think that we'll try to see whatever question we can answer. And I would like to thank our ICAP team, who is not on the front line. They're behind the camera, has done a great job. And definitely I'll not name all the team member, but my message is being conveyed to them. So thank you much for support for this thing. Now, without going too much, I would like to hand over floor to our speaker, Hamid, to provide their expert view on this. Hamid, over to you.
Right, thank you very much. First, I'd like to thank ICAP, especially Mr. Ashfaq Tola and Adnan Haroon, and their team really, who has worked so hard in supporting me to complete this presentation. I must also mention that I'm so pleased that Oman Coordinating Committee is really behind taking ICAP this first international event. So well done, Adnan and your team. And I hope we'll do many more such sessions, And also, if you really look at it in terms of going international, you can't really ask for more important topic, as Mr. Riaz and as Mr. Ashfaq said, than oil, because oil really impacts us all. So can I ask please to move to the next slide, please. Right, so here in the visuals, if you can see, I've just sort of, it's really a refresher to all of us, you know, getting the mindset started for this presentation. So on the right side, you can see oil is involved in so many products. So many CFOs and so many CEOs obviously are trying to look at planning their products, the cost, all these things. And oil is one of an important part of that cost. So it's very relevant that we look at today as to what are the things that determines the oil price. On the tech side, if you really look at it, even from a government point of view, you know, if you, a $10 movement in the oil price can have as much as 5% impact on the GDP growth. This is not me saying, this is international, you know, IMF and all the rating agencies and the likes, they have sort of made this statement. If you really look at oil price, if, you know, it affects all the important sort of metrics of the government economic indicators. If you really look at it in terms of, if the oil price is high, you know, the current account balances of oil exporting countries get better. If the oil price is low, you know, the importing country benefits. And along with the current account, you have fiscal deficits as well. And all these two determine the foreign exchange currency value of the currency of the countries. And and it also impacts with the currency, it impacts the inflation, it impacts private sector growth, debts, and employment. So you can imagine now, I mean, I hope I've created a kind of a mindset. We are all excited now to really look at it, what really determines. So let's start with this. Can we go to the next slide, please? Right, I purposely started, you might be wondering, hang on, where is demand and supply? What is this money manager, you know, sort of graph doing in front of me? But I've purposely chosen this first because I'll try to get the difficult bit out first, you know, then it will be smooth sailing. So if you really look at its graph, what I'd like, first thing, important thing I want to mention, really, there are two aspects that I would like you to look at it. I would like you to look at the right side, yellow shaded areas, and can you see a little V drop going down? This V drop is, if you make the graph bigger whenever in your own sort of time, you will see it's one of the biggest drop that you had. And this I'm talking about, it happened in April this year. Why it happened? Because, you know, we had what do you call the day traders, you know, which are basically retail investors sitting there. There were brokerage firms, I will not name anybody because I'm on ICAP platform, but there were brokerage firms which were sort of offering free trading. And there were sort of derivatives products on which they are offering free trading. So a lot of retail day trader went into this WTI futures. And if you just see before the V, you can see a peak, right? And this is what these retail investors were taking the price up. In the WTI contract, which is basically the American oil, you have to have a physical delivery. And usually what happens is, basically, you, can we have the slide, please, again, if it's okay, because I can only see, can we have the slides? Hello? I can't hear, I can't see the slides here, but anyway, I'll continue. I hope it's working. Can you hear me?
Yes, we can hear you.
But I can't see the slides, so I'm hoping that you're going to put the slides, but I'll continue for this time's sake. So if you guys are all seeing the slides, and it's only me, so the point I was trying to make was this: day traders took the price up at a free cost of brokerage, went into derivatives, were caught at the wrong side of the hedging trade, and that's why you saw, you know, because they couldn't unwind their trade, and therefore the WTI prices really went as low as -37. And here I like to demonstrate the importance of these money managers. So do not ever overlook the money manager's position. The second aspect for this slide that I wanted to highlight was that, can you see now after the V on the right side is coming up? So money managers are getting cautiously bullish. Right, can you please get the next slide? So why they're getting bullish? Please, next slide again. And I'm going to now look at, there are many elements, obviously, and now we're getting into a little bit on fundamentals. So let's look at what's happening to the demand side. And here, what I've looked at it, if you look at the left chart, this is the United States refinery utilization. And you can see very clearly that the utilization of, and if you look at the brown sort of line, which is 2020, it's really even above the 2019 and the shaded area, which is an average of 2015 to 19. So you can see that, in China, this is the China on the left side. Sorry, I stand corrected, not US, but China. So China capacity utilization of refineries have now crossed even the previous year and the average of since 2015, between 2015 and 2019. Let's look at the right side of the same chart, US refinery utilization. Here as well, you can see while the US refinery utilization has not crossed the last year and the average, but you can see the steep sort of curve going up. So next slide, please. Now we'll see what is the impact of the this utilization of refineries. The impact is the storage. The inventories are going down because, of course, as the refineries are using more oil, the inventories of US. If I would like you to see the first left top chart, the blue line, and if you really look at it in the last few weeks, it's all negative. You had a 10.5 negative, you had a 7.8 million negative, 5.1, and last week it was 1.6. And the chart immediately below is really the capacity utilization. And the capacity utilization has now sort of gone to 59% capacity. And these were really the two things which were really causing the concern, which really led to the April and humongous fall in the decline in the oil price back in April, because people were really concerned about the storage capacity. The storage capacity was a big concern, and therefore the price was there. So the utilization is up, the inventories are down. Let's look at why. So please, next slide. Now, next slide, please. Yes. So now here I'm giving, next slide, the aviation slide, please. Yeah, this one, please. Thank you. So here, this is one of the aspects. Okay, it's not. So there are a couple of slides that I've chosen because of the time sort of constraint. There are a few others, but if you really look at it, this chart here, I'm trying to show you the global aviation growth. The flight departures, average flight departures in each week, and this is the latest up until sort of August the 11th. So you can imagine, I'm giving you the most relevant and latest information. And here a point to see that, look, on 4th of July weekend, just after 30th of June, the American Independence Day, Europe was coming out of it, it peaked. In Europe, we had the most sort of, hot days, and it peaked. And then suddenly the virus, was resurfacing, and immediately it went down. And if you see in the last few weeks, it is again going slightly up. And the thing to watch here is really these, if you look at, China, the red color one, you can see is growing quite more than the red color a week before. And the same thing is with the rest of the world, the black, and then the APEC. So that's one indication that jet fuel is being consumed. That's why refinery is consuming more. Storage is going down, and the hedges are getting bullish. Let's go to the next slide. What is another reason? Now here, if you really look at it, what I've looked at is the congestion, the traffic congestions. So if you look at it, to China, the congestion rates are going up. Japan, Southeast Asia, India, all the green bits, we are getting positive. So, and this is really as late as just 2 days ago, August 28th. So these are a couple of reasons. There are other reasons as well, restaurants, footfalls, all these sort of things. But I just wanted to give you a kind of a sense as to why the demand is going up slowly. Okay, I don't want you to get excited about that is going to change and we have got it. I'm just trying to tell you what things are today. And my main sort of focus really is for you guys, the CFOs, the CEOs, or the government people to really look at these kind of indicators so that you can remain ahead of the curve on these. Let's go to the next slide, please. Right, let's go next slide again. So we are now going to focus on supply. Now, in supply, I would like to look at it, again, I want to be very clear about it here, that a lot of the oil that we get today, whatever it is, 9 million barrels per day, or you might sort of challenge me and say it's 80 million because whatever, it doesn't matter. A huge element of it comes from conventional oil. And here I'm just trying to share with you some statistics along with a little map as a shadow to tell you where these big fields are. And this is from Rystad Energy, which is a Norwegian consultancy company. So what they are saying is that 25 fields account for 25% of the global crude oil, 100 fields account for 50%, and 500, 75%. And most of these fields are declining. And if they are declining, as in oil, any oil expert will say that we need to then obviously find more oil. And when you are trying to find more oil, you need money for exploration, which is risky. You might not get anything. And you need more money to create, for the rigs and for the drilling. So this is what I call is a concentration risk. And we'll look a little bit more, and I'll make reference a little bit more onto it. But from a mindset point of view, please remember that most of the oil is concentrated in really around 500 fields. Let's go to the second slide. Next slide, please. Can we have the next slide, please? Yeah. Here, I'm just going to talk a little bit about shale, but I'll go more in detail a little bit later. Okay. So here, in shale oil, remember the first slide that I mentioned that one of the things that is really, really sort of critical for oil prices, it creates employment, and US, shale oil production creates a lot of jobs, and that's why you see Mr. Trump, President Trump very clearly says, we will never let the great US oil and gas industry down. What I would like to say really is that you can't kill shale, but you can only change the owners. What I mean by that back when the oil price started sort of declining back in 2014, Mr. Ashfaq Tola mentioned about $140 dollar oil back in July 2014, and it went that those companies of shale oil was owned by mom and pop companies, individuals. When they went down in 2016, I'll come to 2016 in one of my charts later, but what happened was those were taken over. They all went bankrupt and their ownership changed, and the new owners came. And those were all investment companies like BlackRock, and the oil majors started taking over. And this is what I mean. At this stage, I will also want to say that US shale oil obviously is getting competitive on really daily basis, if I use that word, through vertical integration, because what they're doing is they're going to take over, because remember the owners are now big investment houses. They got the deep pockets, so they're taking over the services company so that the middle person is gone, and they're getting into automation. Next slide, please. Now, remember I mentioned that most of the oil is sort of really concentrated on these 500 odd fields. Now here I'm trying to tell you what is the global oil gas producers capital spending. You look at it in 2015, it was around 780 million, and it's gradually going down, right? And if you really look at it, what's happened in 2020, I mean, they had budgeted around about 461 billion. Is from the budget, it's only 338, and what you can very clearly see is just a decline. But just imagine, as I explained to you, those 500 sort of old field that I showed, if we are not going to invest in it, where will the oil come from? And this is a ponder I would like you to think about it, what's going to happen to the oil price, and we'll talk a little bit more. Please remember that. Let's go to the next slide. Now let's get exciting, and here I'm trying to get a little bit technical, okay? And and really this is thanks to what I've learned from Petroleum Development Oman and other oil companies, sort of professionals that I'm fortunate enough to be sort of near, and I can get a lot of information. What I want to tell you here is a little bit of an education, okay? What I'm trying to say here is shale oil is, if you see the picture that I've given you on the right, is like a rock, okay? And from where we are trying to get oil. So what happens in that is that, there is, if you can just imagine, it's only a kind of a rock. There is finite amount of oil in each rock, okay? And when you take that out, then the oil is not there. So I would like you to look at this table, which I've given in this same chart. And if you look at in 2018, I mean, the decline rate was around 50%. So shale oil, what I'm trying to say is very different. In conventional oil, you have big wells, where the oil is there and continues to flow into it, and you can take it out. So the decline rate is not that much, but in shale oil, it's a finite capacity. So what happens is that once they are there, you need to drill more wells to continue to find rocks and, fracture them and then get the oil out. This, please, can you go to the next slide? Here is a very interesting element. Okay, so here, remember I mentioned to you that in shale oil, you need to drill a lot of wells. You need to drill well, really literally within short spaces compared to conventional sort of oil drilling, which is relatively further apart. So what the technology has sort of managed to get is what we call is pad drilling. Pad drilling is you can drill 14 or 10 or 14 wells at the same time. And that was, I'm trying to show you the picture. Can you see the drill that it's cutting? It has many, many arms, and that's what literally happens. So what it involves is, if you're going to drill 14 wells, or 10 wells, and then you have to fracture them. As I said, you need to go put holes into the rocks to get the oil out. Now here I'm trying to share, if you please look at the blue line and just look at right at the end on the right side, and you will see that the rig counts, which is where the drilling takes place, rig supports it, has gone down to 165 in June 2020. There is a June 20, and you can all see it's 165. And you really follow that line up, and you will see in February it was 533, and in November it was 618 rigs, which sort of accommodates the drills, the pad drill. So you can see a steep decline. Now I would like you to look at the circle area within that chart. And I would like you to look on the left bottom, which says May 2016. And remember I mentioned I'll come back to 2016. 2016, February was where the oil price went down to 25. And it was almost exactly the same. The rig counts came down to around about 193. Can you see May 2016? And if you follow up that blue line, it went to 568 rigs in April 2018. What I'm trying to tell you here, that it takes 2 years to bring from 193 to 568. Now you're 165. And if the shale oil decline rate, as I explained to you in the previous slide, is significant, there is only certain amount of oil which is left in already drilled wells. All they will do is they will basically, what they've done is they've turned the tap on or off so that the oil is not coming out because the prices are low. They can easily turn the tap on and more oil can come out of it. But they will it's a finite one. So they need to replace this. And all I'm trying to say that once that runs out, is going to take two years. And that's where, I'm a little bit bullish on the oil price a little bit later, but that's for later. At the moment, I just want you to digest that the rig counts has gone down significantly, 165 to produce 13 million barrels. And by the way, 13 million barrels of USA is not all shale oil. It's conventional oil and shale oil as well, okay? So to produce 13 million, they needed 600 drills. Right now, last week, it was 10.7 million barrels. And if you just imagine that from 195 to produce 13 million, they have to get 600. And that's what I want you to do. You're all finance guys, you love figures, and you can see what I'm talking here, that it will take time to get the shale oil back once the oil in the rocks is finished, you know, and that would be a very important thing to watch as we progress in your, you know, a week from now. Said how does the U.S. oil production sort of behaves? It's gone down from April from 13 million barrels to 10.7 million barrels last week. Next slide, please. And you know, this is what I'm now just saying, that all these you know, agencies like Rystad, IEA, and all those sort of things are also projected the same note after 220. It's significantly, you know, putting down, it just says US oil production faces a long and uncertain path. Remember, I keep repeating, okay, that finance is becoming scarce. And this really ideally now brings us to the next slide, please. Next slide. Here. Now, what I'm here, why I'm saying finance will be important is again a very interesting thing. We are all among energy transition. You know, renewable is becoming the name. You know, IEA, which is a European-based oil, you know, sort of stats agency, statistics it gives. They are projecting by 2050. You know, at the moment, oil, as I explained to you, oil is, we are producing around something like 90 or 80 million, whatever you do. They are saying that alternative energies will come, renewables will come, and therefore the oil will only, you will only require around 50 or 70 million barrels. Remember this, I will come in the geopolitics slide on this one. Please remember this, just remember this amounts, okay? Coal, if you really look at it, has already, at the moment, the consumption of coal in energy use has gone down to 1980s level. Why? Because gas has become cheap, you know, and that is already. And if you really look at today on the market capitalization on the S&P 500, you know, which is a US index, it's gone down. You know, the oil companies, oil and gas companies used to be around 14% of weighted average market capitalization, is gone down to 4%. Obviously, it's nothing, it's not all to do with fossil fuels or whatever, because some of it is all these amazing, you know, FANG stocks and all those sort of thing. But there is a shift. There is a shift. Investors are getting a little bit worried about fossil fuels, and therefore they are moving away. And, you know, all the big universities, in fact, the, you know, the California University Hospital Pension Fund is a very great friend of mine, and I was talking to him recently, and they have publicly announced that they will not be financing fossil fuels, and they will not be investing actively or passively, both. So, and then even the Norwegian pension fund, you know, is also made the same kind of announcement. European banks have already made. So what, again, I'm trying to draw back this, that you saw that there are only 500 fields of conventional oils. The capex you saw has gone down from 780 million to 338 million. And here, you know, there are big financiers saying, no way, Jose, we're going to be very careful. So it's very important to see that, can we find an alternative? Will we really able to find? So really the question will be, will we find the finance to continue to finance the fossil fuel? And will we be able to find the energy transition? And that's why I will look at a couple of months. So next slide, please. So let's look at energy transition, okay? Here, what I've done is one aspect of it, EV stands for electric vehicle. So if you really look at this chart, you know, and if you go back to 2020, you can see the 2020, right? It's a very piddly little graph, okay? I can tell you it's around 2.5 million vehicles. And when it gets to 2040, you know, there's projected growth is around 55 million vehicles all around the world. And I've given you different countries as well. But the vehicles will, okay, the projections are there, but it will require resources, right? You need to have connectors to charge the electric vehicles. Just see the graph on left at the bottom. See the steep curve going up as to how much growth they will need, home and work, public, commercial. It's a steep, you know, curve up. So there will be humongous amount of resources required to really cater and enable all these projections to get realized. On the right side is the same, lithium batteries. Just see what is the curve there. And so let me, please, can you go to next slide now? I'm just summing it up with regards to the demand. So next slide, please. Here, I'm sort of trying to tell you what will be the demand required for all these projections. Just see lithium, you would need to produce nearly 3,000% more cobalt, which is a material, significant amount. And the same thing is rare earth. And most of the rare earth comes from China. And we are going to have a trade war with China, right? And graphites and nickel. So all I'm trying to see, look, I'm all for energy transition. I really want. Climate change is very important, but I would like the government sort of, officials, excuse me, and remember the first slide, the CFOs and the CFOs of the producing company to really have a ponder and do a little bit more, because if we are caught out here, that could be significantly bullish for oil price, because if these resources will have to be mined. Just imagine, what will be the price of these resources. If this price resources are wanted, supply demand, and if this demand goes up so high and the supply is not there and the prices go up, will EV vehicle be competitive to the non-EV vehicle? And this is a thought. Obviously, these are my views, my thoughts. You will have your own thoughts, but I just wanted to share this. Can we move into the next slide, please? Okay, now this is my favorite subject, geopolitics. Okay, now if you look at the top, what I have written here is basically trying to tell you that today we are in the world of 90 million barrels or 80 million barrels. And as I said, remember EIA, the slide was telling that it will go down because of the energy transition. So, with 90 million, okay, go to the next slide, please. We look what happened. Next slide, please. Yeah. Now, what I want to show you is because of the sanctions that have been put on Venezuela, and if you really look at Venezuela, this is a green line. Just look at the green line, and right around 2015, Venezuela was producing roughly something like significant amount, about 5 million or 4.5 million barrels a day. Look what is now producing on the extreme right side, 315. And the last thing and this is till June, okay? And the last I saw was only 100,000 barrels. And this is market share, right? Because when at 19, please go up, not this slide, the slide before, please. This one, yes, please. Keep at this slide, okay? The same thing happened with, if you really look at Iran, okay? Iran, which is yellow line. Sorry, the slide, next slide, please. Yeah, this one, stay on this slide, please. So if you look at the yellow line, which is basically Iran, again, Iran was producing roughly around 3.5 million. Look where it is now, 100,000. Okay, and so these are sanctions thing. Then if you look at war, which is happening in Libya, look at what Libya is white line, just look at what Libya was just a couple of years ago and look how the production has dropped. And the same is with Iraq, which is sort of the kind of a reddish maroon line, okay? So all I'm trying to say to you guys that, when the alternative fuel takes over and the market share universe goes down from 90 million to 60 million, at 90 million, we are having such fights. What's going to happen when it's gone down to 60 million? Next slide, please. Okay, here, so those were my ponders. Now I'm just giving you I know people ask me, okay, so here I'm trying to give you kind of a projection from three, agencies, OPEC, IEA, and EIA. OPEC, you know that. IEA, I've told you this is French one, and EIA is the American one. And if I would like you, instead of getting into numbers, please look on the right side on the graphs, okay? Starting from this quarter, all of them are saying that there will be a supply-demand deficit, i.e., demand, the surplus of oil inventory is going to narrow down, and there will be now shortages. Okay, and this is this quarter. Okay, so just wanted to share with you why. Because as I explained to you, the supply issues. Really, the critical thing which I feel will be to watch out US shale output for the next few weeks. If the US shale output goes down, continues to go down from 10.7, shale is not to 10.7. Part of it is that it's a dominant part of important part of it. then you know that shale decline has happened. The finite amount of oil in the rock is gone, and now they will have to do the rigs. So there you can start becoming bullish that the prices will go up, because you know that. So that's a very important indicator. The second important indicator, of course, we have to look at it is how this little, cautiously demand is improving, because I believe that, yes, viruses have not been sorted. We don't have the vaccine, but I really feel that the lockdown intensity that we are seeing is not going to happen. And remember, in April, okay, we had a double whammy. First whammy was that Saudi Arabia and Russia fought and continued to produce. In April, Saudi Arabia produced 10.2 million barrels. In June, you know what they produced? The record lowest production, less than 5 million. So I think they've learned their lessons. So I don't think that will repeat. And you remember when I mentioned the day traders, which went on the hedgy, went completely on the high. That's not going to happen. So I really feel those were exceptional events. Of course, the demand side can be an influence with the virus, but all at the same time, as I explained to you, the supply side, depending upon how the US shale oil production happens in the next few weeks. But right here, all the three agencies are forecasting that starting from this quarter, you will have all these sort of turning into negative. Next slide, please. But this will be a very quick slide. Next slide, please. Now here I've basically outlined, the projections made by various agencies. I have even done the 18th of August, so just a few days back, Bloomberg consensus. What I do, Bloomberg consensus gives you till 6 months. So what I do is I use my own sort of intelligence into it. And what I've done is basically taken the average of the last 20 odd days projections made. And these projections are mostly made by investment banks like, Citigroup, JP Morgan, the likes, all these things. So that's the average of what they're forecasting. Because, oil prices changes, the parameters or the influencing factor, Mr. Trump tweet, can also change the oil price projections. So therefore, I've just taken the last 20 days. Then you have Wood Mackenzie's, IHS, Oxford. So all these projections, what I've done, World Bank is there, but because World Bank is dated April 20, so I've taken it out as well. I just wanted to show you that. And those are the projections which are being made. But really for me, if I was following something, I would keep an eye on futures prices. And if you really look at it, it's amazing. As you are near in a short term, the difference between the analyst and future is not that much. But as we go into long, i.e. 2022, 23, the gap is going up. Next slide, please. So I'd like to really sort of conclude here, because what we need to be absolutely sure, I hope today, by going through this, I have given you enough important information that all of you can now really follow these things and have your own outlook, because your industry experience, your country challenges are very, very important, and therefore you will take your own view as to how you are going to mitigate those things. But what I want to say in this concluding remarks is really geopolitics, climate change, socio-economic stability, i.e. Libya and Iraq, what happens in Libya and Iraq. So any other countries, because if the oil price sort of remains low, it's going to bring economic pressure on other countries as well. So all these things really will determine the oil price. It won't just be the fundamentals. You have to look at a broader spectrum. With this, I would like to conclude. Thank you for your time. I know people from America to Australia have joined in, so I wanted to make sure that I sort of finish well within the time, and I think I have. So thank you very much, sir. Adnan, put your mic on because your mic is mute.
Yeah, many thanks, Hamid, for providing insight on the various aspects, linkage from inventory, refinery, the global aviation, concentration, shale oil, and alternate source of energy, as well as marketing for the future oil price. Much appreciated. Thank you. Definitely, oil price plays a significant role, especially for those economies where the GDP depend on the oil as well as for those countries who imports. Now, I think just from my own observation on the last couple of slides, and before we move on to the other questions, looking at your supply and demand slide, and as you rightly said, that seems that in the next 6 months, demand is going to be exceeding supply. And if I look at the outlook, oil price outlook by World Bank and Fitch and Moody, so I think I can see that not that much of correlation in terms of the price, but if Hamid has to really project the price, future price in the next 6 months to 1 year, what would be?
Wow, you're putting me on spot, man. But I would like to have a disclaimer. I don't want all these. I understand you got about something like thousands of people joining. So please don't sue me if I don't make your own judgment, okay? And really here I'm talking on my capacity. All what I have shared today is in my capacity. I don't represent any institution, especially Ministry of Finance. So again, that needs to be really made clear. Look, as I explained to you, and I kept on hammering many times that really, the demand situation, i.e. how the virus sort of, is it going to resurface? Again, a lot of people are worried about it. I feel the lockdowns will not be as intensive as we did, as I explained to you that Saudi and Russia, whatever they did is not going to happen. The day traders are gone. Incidentally, those day traders, I must mention that the day traders were people who were getting this special allowance that the USA gave $600 a week above and beyond the unemployment allowances, which in USA was around 250 or something. I know some states are giving 400 and some states are giving less. So all these people who got 600, they got excited. They said, we can become a millionaire. So they went to this, and took the hedges out. So all these things hopefully are not going to be repeated. I'm really concerned about the supply side of it for sure. And the supply side, as I keep on sort of saying to you, Adnan and all the people who are attending, please keep an eye on US production. If the US production, it's already declined from 13 million barrels to 10.7 million barrels last week. And if it keeps going down, there will be no reason not to feel bullish, because the oil price, and I feel even if it goes up, okay, I think it's only a matter of time because the rocks have got finite oil. Decline rate is very high. That will exhaust in next few months. So I feel really, I'm pretty comfortable that I think oil prices, will have a lot of volatility. Don't forget US election is coming as well. There'll be a lot of volatility coming in, but I think once we pass beyond sort of February, after we are sure that either Mr. Trump is staying or Mr. Biden is there. I think around sort of like maybe March, April-ish, you will start seeing, because as I explained to you, the rigs counts will take time, right? So I think the oil price can be anything between sort of like 55 to 65 or even 70, and it's not just me. Rystad Energy has publicly disclosed that it will be around 70. Moody's are saying it's going to be 70s. So that's what I think. So I'm a little bit more bullish, in medium term, not in short term. Short term is very short term. I mean, next 6 months or something like that. But in medium term, I think. But of course, don't forget Shell. Once it's back in action after 2 years, then it could again play a little bit of a naughty thing. And we'll also have to look at how energy transition takes place, because if you really look at it, few days back on 14th of August, there was a massive blackout in California, and from what I've read so far, I'm not an expert on this, but from my reading, I see that because in California, they rely a lot on, wind energy and solar energy. And what had happened was that they could not keep up with the demand. It was very, very hot, in California. So, and then you saw, with the Indian auction being delayed for the wind energy project. So there are a lot of uncertainties as we move down the road on the energy transition, a lot of risk coming. So I really feel that medium-term oil will be okay. Long-term depends on energy transition.
Thanks. We got a few questions, very good questions in the panel. One question is that when energy transition has certainly gained momentum, how smooth will it be? Who will be the gainer or the loser? Wow.
I've already answered that question, but again, I'll repeat that because energy transition depends upon the resources, how they will be available. You know, there's a humongous amount of requirement of cobalt, lithium batteries, rare earth. A lot of rare earth is coming, and obviously continuous evolvement of technology. Technology is a very important element of it as well. So I really feel, that the energy transition has a lot of certain. It's positive. I mean, if you really look at all these BP statistical review also mentions today, I think renewable is around sort of like 10%, nuclear energy is 5%, so 85% is fossil fuels. By 2040, they're projecting that it could be the alternative energy could be as high as anything between 25 to 30%. So still fossil fuel will be quite significant, and obviously the gainers, I feel one of the area, and I know some of the independent power providers are there on today's session, so I'm sure they might challenge me, but I'll stick my neck out and I will say that, I think with solar, you will see decentralization of electric generation, so we'll all have on our houses solar panel. We already have it, with the technology. So do we really need, independent pump? Of course we will need for sure. But what I'm saying is there is that thing. So the gainers will be, I mean, in the UK, I have at my house, I have a solar panel. I've already discovered 400 pounds a year saving, because of that. But right now, energy transition will need to be supported with government subsidies. I'm not sure, again, with these resources, as I explained to you, if the prices of copper, cobalt and all goes up, will there be subsidies still there? Back in China, I think at the end of last year, you were seeing that as China was removing the subsidy, the electric vehicle sales were going down as well. So the gainers will be consumers in any cost, right? If we win, and even in this part of the world, in Oman, energy intensity is quite high. We have already sort of committed ourselves to 30% of our energy being generated by 2030 from renewables. So when we generate basically our energy with renewables, there is more barrels to be produced and sold outside, refined into value-added products, right? Because in Oman, we still have subsidies on that. So I think the situation is the same in Pakistan as well. So you will even the less molecules you use, and you're able to produce solar, then even countries who are importing will benefit as well.
Thanks. And I think one more interesting question on the US dollar. Wow. If fossil fuel demand is declining, what impact it would have on the US dollar? Wow. Good.
Wow, that's amazing. Excellent question. I must say, excellent question. Really, yes. I mean, if you really look at today, US dollar, is around what 75% of the trade sort of which takes place, and a lot of it is to do with fossil fuels. Fossil fuels is traded in US dollars. I know some China and Russian deals are taking place, and some other areas are traded in Europe. But then look, what is the alternative of US dollar? We are having a massive, sort of injection of liquidity, right? I mean, in fact, if you really look at US dollar in recent sort of weeks has gone down. And one of the reason it has gone down is people are significantly worried about the quantitative easing, the liquidity that the Fed is providing. And people are worried. The foreign investors are still there. I think I shared few days back in one of my WhatsApp group, where I was saying that yes, it has gone up, but the rate of growth is not there. So what is the alternative? And for me, I mean, if you go to the as we were talking about the transition by 2040, that from 85% fossil fuel to maybe 70% fossil fuel, we got a lot of time, right? And I believe in between this time, I'm pretty convinced. I mean, recently I've written a paper in the Global Innovation Index on sovereign wealth fund investing in innovation. And, I feel that the technology will do, and I think there will be, I mean, China has already started digital currency sort of experiments in Shanghai and a few other towns. But I believe if I was to make today, 22nd August, a prediction, with all the disclaimers, I think there will be a Silicon Valley digital currency. I know some of you will say, oh, hang on, Facebook came with Libra, but Facebook came very excitedly and made it very public. This will be done very smoothly, getting all the political high and might in USA and other countries on board. So that could be the challenge to US dollar, Silicon Valley digital currency, SVDC. And if you hear this, please give the patent to me.
Thanks. Amit, I think that we are running short of time, so I think we will not be able to get all the questions for your to answer. I think that I'll just pick up a last question, so then we can move forward. It said that the tankers, almost 3 dozen of them, were carrying enough crude oil to meet the needs of 20% of the world's oil consumption. Yet they have nowhere to go. This is due to demand for the fuel collapsing. These tankers are pretty much floating short storage units for barrels of oil. We'll appreciate your views.
Right. I mean, look, I mean, floating sort of storage was around about something like 240 or 50 million, 40 million something in Aprilish, when people are getting, that's what all the excitement, all the worry was, that would we run out of the storage facility. Is now gone down to roughly about 160, and a lot of it, 80 million, is in China. And why in China? Because China, and this has got no worries about storaging. China obviously, sort of exploited, if I use that, not exploited, I think, I wouldn't say exploited as well, because I think they were pretty clever. And even India has done it, actually, to be very frank, where basically they have imported a lot of oil. I mean, last year, floating storage in China, I'm just talking from memory, around was 7 million barrels. Today it is 80 million. So out of that 160, the floating storage today, a lot of it in India and China is really them procuring oil at a very, very cheap rate. So I don't think it's any more a concern. As I explained to you before, again, during the presentation, very exceptional events took place. The hedges got it wrong. Russia and China flooded the market. As I explained to you, Saudi was producing 10.2 million barrels a day. Today, they are producing a record low of 4.8 million, not producing, but exporting. Sorry, I stand corrected. Exporting. So I really feel those things are not going to be, but you saw in the chart, the utilization rate has gone, the storage capacities in USA has gone down to 59%. And also I will tell you that there was when it was really getting to 70 or 75% storage capacity, sort of being used, USA started letting the strategic reserve, capacity allowed, so that some of it could go down. Now that strategic capacity last week has gone down by 2.3 million barrels as well. It is keeping going down for last 3-4 weeks. So I don't think floating storage or the tankage storage, and that is evident from the top. If you look at the tankers, rates have gone down tremendously. So my answer is a lot of it is being used because it was bought cheaply. And that's occupying a significant element of floating storage.
I think, thanks, Amit. In fact, we have a lot of questions. In fact, if I look at the list here, it's still, in fact, we need another half an hour, 45 minutes to really answer those questions. But unfortunately, with the time limitation, we can't move forward. So I think what I'll do, in fact, whatever the question is there in terms of, I'll request the coordination team to send us separately, and if there any way we can post somewhere to answer these questions. In fact, they're very good questions, some of the political, some of these fossil related to. So I think that I will end here, and I will pass on this mic to Khalid Rahman, who is our council member for the vote of thanks. Mr. Khalid Rahman, over to you.
Thank you very much, Adnan. Really, it's a great pleasure to be with you all today, and especially with my background and experience of working in the energy sector. I personally found the discourse and the presentation to be highly enriching. Thank you very much once again, Adnan, for inviting me and to bring me on this platform. Now, formally, I would like to say Assalamu alaikum to all the ladies and gentlemen who are attending this webinar. A very good evening. the topic of future oil prices is of extreme importance as fossil fuels remain a major source of energy and has a direct impact on the global economic recovery. You may be looking at alternatives, but trust me, with my 25 years of working in oil and gas, I hear it, I've been hearing it for the last 20 years and nothing has changed. And based on the presentation of Hamid, we are more convinced that this is fossil fuels is nowhere going in the times to come because there seems to be still a balanced gap between demand and supply in terms of the fossil fuel. This webinar is an initiative of Oman Coordination Committee of ICAP members and who held their hands with the Overseas Coordination Committee under the lead of Mr. Ashfaq Tola, and I'm grateful to Ashfaq to have asked me to come and give a vote of thanks since he has been preoccupied in some other urgent travel engagements. And also since Ashfaq is the chair of the Economic Advisory and the Government Relationship Committee, so he wanted this webinar to come under that platform as well. So I want to congratulate the Oman Coordination Committee under the lead of Adnan Haroon. Thank you, Adnan. Great job done. And your other colleagues, Kashif, Kalam, Tayyab Raza, and Kashif Arab. And it's great to to see you having a big bash just at the beginning or start of your coordination efforts. Now, coming to the presentation, which I should have come right at the beginning, the presentation of Mr. Hamid Hamarani was absolutely brilliant. It captured the dynamics of the oil prices and basically the whole market dynamics in terms of how the oil prices have an impact on the exploration and the vicious circle that we go into. That when the prices come down, the activity comes down in terms of exploration. And as he explained, that in terms of peak 700 drills which are operating, with today activity, it has come down to about 160, 170 wells which are operating. So you have to bridge that gap. And then we realize that we did not carry out much activity when there's an economic boom, and then the prices shoot up, and then everything starts again. But there is always a time gap. So it's a vicious circle which we continue to move. And I think Hamid really presented this point very beautifully. It actually captured the dynamics of the oil price movements and its impact on the exploration activity. I'm personally highly enriched with the information presented, and I'm sure that our audience would have also benefited from the discourse. Also, I agree that going forward, a lot will change based on geopolitics and the climate change, the sustainability, and the social economic stability of the oil producers and the access to the capital markets. That will bring in exactly what will happen in the future as far as oil prices will go. Nobody could have ever dreamt of a pandemic, and it happened. And here we are with a total drop in demand, with the whole activity coming to a standstill. But anyway, that's where we are. And I just wanted to compliment once again to Mr. Hamid Hamarani for presenting the point of view extremely, very well and very beautifully. Thank you, Mr. Hamarani. On behalf of ICAP, I would like to record my deepest gratitude to Hamid Saab and for giving his valuable insight and for making this webinar a success. Now, since I have been also involved with the Overseas Coordination Committee for a long time, and I'm very passionate about it. So I try to be as passionate as Ashfaq is, but definitely he's doing an excellent job. We have already chapters in 7 jurisdictions, and we have overseas coordination committees. And I'm glad that we all could have, work together to bring coordination committees on board, the South Asian Coordination Committee and the Oman Coordination Committee. And I'm sure that our overseas members will benefit from it. The whole idea of the Overseas Coordination Committee and the chapters and the coordination committees is to bring the members close to its mother institute, and also to be able to extend all the knowledge and enrichment that they are not able to get being overseas, and which may not be afforded.
I think we lost Khalid Rahman. Khalid Saab, can you hear us? I think we lost the connection from Khalid Rahman Saab. Anyhow, I think that if I would like to just conclude in a way that thanks, I think, Khalid Rahman Saab for your valuable input, and definitely this is one of the initiatives that we have taken in the future. Inshallah, I think that we will take further initiatives to engage other stakeholders and other chapters, as well as committee members as well. So once again, thank you to all the council members and the support team, in fact, behind the scene, in fact, has been there. And special thanks to Ashfaq Tola, who really has supported us in terms to move forward on that front. With this, I would like to thank you all the team members, all the ICAP members, non-ICAP members who have watched this thing. We definitely look forward for another session soon, inshallah. Allah Hafiz. Thank you very much.